But if you had to kind of put a gun to my head, I would say the asset first.
Hi, and welcome to Basis Points. Private equity careers are often shaped by timing. Today we meet PJ Fredericks, head of direct investment at Unigestion. He started his private equity career in 2008. Yup, he stepped right into the financial crisis. A formative moment, one might say, that left a lasting mark. Since then, resilience, downside protection, and disciplined underwriting have become central to how he approaches investing. At Unigestion, he leads the private equity investments, partnering closely with specialist buyout managers while maintaining a strong institutional framework. This first episode is about path, platform, and philosophy, and why, in private markets, structure and selectivity matter as much as conviction. We hope you enjoy the show. Don't forget to like and subscribe if you do. Okay, let's go and meet PJ. PJ Fredericks, so you started your career in private equity in 2008. Great timing.
Yep.
How did the great financial crisis impact the private equity scene and your coming into that world? I mean, because it's like starting a home decoration business when the house is on fire.
Very true. So I started my career actually in banking M&A at the height of the market. When I then moved to private equity, I found myself at the start of the GFC, the Great Financial Crisis. And to make matters worse, I joined a firm that was focused at that time predominantly on media services, so quite procyclical in nature. So I could see firsthand as a junior private equity professional what the impact was of a downturn on the cyclical businesses. So I learned a lot in terms of fixing capital structures, sorting out issues, basically. That probably make me very wary of investing in businesses that are subjected to cycles. But on the flip side, it also kind of allowed me to see then the emergence of other investment instruments, which were basically emerging out of the kind of the troubles from the GFC. So these were more structured products, which gained more popularity in the aftermath of the GFC because people were looking for more downside protection.
And so today you're heading the direct investments team at Unigestion. Can you tell us what that means exactly? What do you do?
What do we mean under direct investments at Unigestion? It's very simple. So our model is that we invest in mid-market companies globally, and we do that alongside other private equity funds. We call them GPs, general partners. In the terminology, we are called a limited partner. And we're making those investments alongside our GPs, very simply because we like to work with the best GPs for particular deal situations. So
do you invest in the fund or in the company that the fund is investing in?
Very good question. So we have, as a firm, we've committed over the last few decades in many private equity funds through our primary program, but also through our secondary and growing secondary program. And that is effectively allowing us to source co-investment opportunities from those GPs, from those managers. So we are investing in the company directly, but alongside a GP, another private equity manager, who we know well through our primary or secondary relationship.
So he's basically managing his fund and says, I got company X that's doing great. He shows you company X, you say, all right, I love this, I'll invest in company X as well.
Correct, exactly. And usually it happens that this private equity firm comes to us because of a need of capital. Either the deal is slightly larger than they would normally underwrite for their fund, or there's particular need for further capital.
All right, so the extra boost that helped them make the deal happen.
Exactly.
So where do you see the benefit in these co-investment schemes rather than just trusting the GP and investing in this fund?
Well, the benefit of investing in a co-investment fund versus a traditional buyout fund is if you invest in a co-investment fund, you effectively have more levels of our diversification. So what we provide as a team is a second layer of diligence. So we receive a deal flow which is already highly qualified by other private equity managers who have screened various opportunities. We usually have a very good angle into these situations. And our job is to pick the best deals out of this very high quality deal flow. So if you were to invest 10 million with one buyout manager, you're effectively having exposure to one team, usually one sector, or sometimes a few sectors, or sometimes a few geographies, but usually very good at one geography. Whereas if you invest in a co-investment fund, then you're effectively getting exposure to many different teams. So you're extending your bench effectively, and you're effectively having a more robust diversification geographically as well as via sector.
So you're basically cherry picking the best out of many opportunities of several different fund managers.
Correct.
What convinced you that Unigestion was the best platform for you to do that?
There's a couple of things actually, because this is all about being a good co-investor, or generating the best returns and building unique portfolios is all about access and your skill to kind of work yourself into the best deals. So in order to have the access to the best deals, you need to have a USP in the market, and our USP is quite clear. So Unigestion's USP has always been focused uniquely on the mid-market. So GPs know this, our LPs know this, the whole kind of ecosystem knows that we are solely focused on making investments in the lower and mid-market arena.
Why though? Are big companies not interesting?
Certainly they are, but the playbook to create value is a little bit different, and in our view, the risk-adjusted profile is a little bit different. So think about a mid-market company, it's somewhere between venture and growth and large cap, kind of over 2 billion in enterprise value, with most of the exit path being kind of the public market via an IPO. The mid-market, the small mid-market sits somewhere in between. So you're operating in a proven market that is resilient, that is growing, a business model that is also has proven itself.
And higher growth potential as well, maybe?
And then versus the large end of the segment, there is more potential to improve those companies. So usually the partners that we partner with are the first institutional capital into those companies. So they are coming in alongside a founder or founder-led business or family-owned company, where there's still what we call a bit of jargon, a bit of low-hanging fruit, where there's a bit of professionalization to be done with these companies.
And so the GPs you work with actually go and take a seat at the board and do that?
Correct. And in many cases, we also sit at the board of these companies, depending on what stake we take ultimately in the investment.
What do you think is the most important thing to you in the underwriting process? Is it the assets, the manager, the structure, the industry? What are you actually looking at to guide your decision-making process?
It's actually a discussion we have a lot internally, what is the most important. And unfortunately, I'm going to give you a bit of a cop-out answer, which is the asset and the GP are equally important. So what we look for is, but if you had to kind of put a gun to my head, I would say the asset first. So we are underwriting the company. We're doing diligence on the market. We're doing diligence on the robustness of the business model, the strength of the company in that space.
Sorry to interrupt you, but isn't that what the GPs you work with do?
Yeah, absolutely. They will do that in conjunction with us, because we always come in during the diligence process. So we do not come in, or rarely come in, once the deal has been done. So we are clearly, our investment partners, our GPs, are in the lead of that process. We are there to give our input during that due diligence process. And often cases, we do a bit of top of diligence on the side as well.
Okay, so you have like a multi-layered due diligence process.
Correct. So we do conduct this diligence on the market, on the company, its relative strength in that market. We actually also look at how well is the GP positioned to drive the value creation of this underwriting case. So therefore the fit And the fit with the skills of the GP is extremely important for us.
Who are you selling this to? Pension funds, wealth managers?
Predominantly institutional investors. So these are pension funds, these are both public as well as private, insurance companies, but increasingly also wealth managers who provide access.
Because there's growing interest from private clients in private equity.
Yep, absolutely.
Is that a new market that Unigestion is tapping into?
Yes, we will tap into that. Already there are kind of wealth management platforms that have invested into our funds. But of course the retailization of private equity is a clear trend. So there will be kind of funds and more funds in the future which are semi-liquid, so where retail investors can invest and have an option to partially redeem their investment into the fund.
PJ, thank you very much.
Thank you.
And see you next time for the continuation of the conversation with PJ Fredericks, where we're going to talk about the retailization of private equity and dive a bit deeper into these co-investment schemes they have. That's it for today. Don't forget to click below to subscribe to the official Basis Points YouTube channel.